Let's now turn to the advisory. Too many investors focus only on income and risk, missing the bigger picture. Well, that's the view of James Alexander from Alman Partners. Explains why. James, welcome. Good to have you on, Ausbiz. So, I guess particularly when we talk about those at or near retirement age, it's all about capital preservation. So it would make sense, would it not, that therefore you're choosing income generating assets?
Yeah, seemingly you'd think so. Thanks for having me, I should also say, Andrew, my first time on here. Seemingly you would think so, but this bias and this over focus, if you could use that phrase, on the income return component, as opposed to the income return plus the potential capital growth, which always is going to equal the total return of investment, is something that we tend to see as advisors with our clients. So I've had numerous conversations with clients, particularly as they're approaching retirement or in retirement, that will come and say, look, we think we need about $100,000 per annum to fund our living expenses in retirement. We've got $2 million across our superannuation portfolios. So all we really need to do is develop a portfolio that generates a 5% income return each year, and then we don't have to touch our nest egg. It really focused on not touching that nest egg and maintaining capital preservation. But we believe there's some challenges that arise if you focus too heavily on the income return component.
All right, talk us through those challenges then. What are they?
Yeah, well, we always like to say to clients that bring up these kind of statements that you've got cash flow needs, not income needs. That goal of having $100,000 of retirement income is a cash flow need. If you're trying to match the income return of a portfolio exactly with your cash flow need, you can run into some trouble. One reason why that might be the case is that people have less control over the income return of a portfolio than they think. And even an advisor might promise a certain income return on a portfolio, and they have less control over the income return than they might think. Because if you're using, say, shares to generate a form of income return, then that income return is going to be dictated by the company and the payout policy of that company. If you're using term deposits or bonds, then the income return component of those assets is going to be determined by things like central bank rates, not only in Australia, but globally. So the lack of control is a really important factor. Look, if I can give one example. You go back 5 years, April 2020, COVID is hitting, obviously, and there's a lot of uncertainty in financial markets and economically as well. APRA came out and actually started to advise Australian deposit-taking institutions and insurers to be really prudent when it comes to their capital distributions and thinking about distributions or dividends they might be paying to investors. Sure enough, the next month, May 2020, National Australia Bank comes out and reduces its estimate of first half earnings by 51%. They set aside $807 million, I think it was, for potential loan losses related to coronavirus or COVID-19. And because of that, announced that they were going to reduce the interim dividend by 60%. That's, an extreme example of, I guess, a very volatile period in financial markets. But those relying on a security in a company that seemingly had paid a relatively reliable dividend, therefore income return, probably would have been quite shocked to see that income return drop that much that quickly.
Yet, James, as we well know, Australians do love their dividends, and particularly if you are in retirement, it's all about those franking credits. So surely there are those benefits there.
Yeah, look, the one thing or the point we'd like to make is that, again, we're not saying that clients shouldn't consider or focus on income return when developing a portfolio. As I said, there's two important components of total return when it comes to any investment: income and the capital growth. I guess our view is that if you focus solely on one or the other, that's where you can get into trouble. There's certainly a case that for some investments and for some components of income return, so for example, to your point, Australian shares that pay dividends and have a franking component or franking credits attached to those dividends, there's certainly a case that that franking credit may provide an additional financial benefit to certain types of investors, right? So the issue is that if you over-concentrate your portfolio on Australian shares simply because they pay franking credits, it's not always going to lead to a better financial outcome. There's actually some issues, I should say, when you look at maybe an investment strategy which says, well, I'm just going to load up and have a lot of my money because I'm a retiree with a low marginal tax rate, or I'm investing via a superannuation accumulation fund with investment earnings typically taxed at 15%, I'm going to have a really high allocation to companies that pay a high dividend, have a high franking component or high franking yield to take advantage of the potential tax benefits that stem from franking credits. Well, what are some of the trade-offs to consider? Australia does tend to have higher average dividend yields than other developed or emerging market countries. And also a larger number of the companies listed on the ASX tend to pay dividends than you do see globally. I believe if you take data as at the end of December 2023, 213 of the 300 companies that made up the ASX 300 paid a dividend of some sort. But again, if you're focusing on those companies simply because they're paying dividends, you could miss out on opportunities in investments in companies that historically haven't ever really paid a dividend. If you look over in the US, there are very successful companies and businesses that for long periods of time never paid a dividend. Apple, Alphabet, formerly Google, Amazon, really long periods of time where those companies didn't pay a dividend. They're great businesses, and I bet that if you had invested in those companies over the, say, past 2 decades from a total return point of view, that would have contributed significantly to your portfolio. So you're right. It's not saying ignore the potential benefits that can come from income return and can come from franking credits, but you don't want to have that be the driving factor or a sole factor when you're thinking about designing your portfolio, because you can miss out on global diversification. You can miss out on other investment opportunities that provide a higher total return, even when you account for after-tax income and things like franking credits.